Well, good morning. I'm Paula White, and this is Accounting 102, and this is the lecture for week 3. And we'll get started in just a second here. In the meantime, I want to remind you that although I am a resource, you also have the textbook, you also have the recorded lectures, and I put those in the announcements section. I hope you've all been able to find them. Plus, you have the services of the tutoring center. They cannot help you with your answers in the assessments, but they can help you with understanding the material. And they may have different options in trying to get you to understand the material so you can do the assessments correctly. Okay? But assessments are different than assignments. They can get you going the right direction on assignments, but not do it for you. Okay. Let me just resize this just a bit, and then we'll start on chapter 8. Here's where I want it. Okay. Let me size this right, and we'll be going. Oh, there we go. Okay, so today is going to be on cash receipts, cash payments, and banking procedures. Now in chapter, excuse me, chapter 6, 7, and 8, we introduce the concept of specialized journals and specialized ledgers like the sales journal and the purchases journal and the accounts receivable ledger and the accounts payable ledger. And today we're going to be talking about the cash receipts journal and the cash payments journal. And I just want you to know that I know it could be confusing because you started with Accounting 101 with a general ledger and a general journal, and you put the journal entries in the general journal and then post them simply into the general ledger. If you did that for every single business transaction, you would be a very, very busy person. So these specialized journals were devised to save work in entry and in posting to the ledgers. That's why they exist. So when you do a sales journal, when you do a sales journal, all the sales transactions goes into that one journal, and then you post it one time to the ledger. Instead of having 1,000 entries in a month, to the journal and then post 1,000 entries to the ledger, you have 1,000 entries to post to the specialized journal, and then one summarizing entry to the ledger. Now, what happens when you have a credit sale? You have to also make sure that we continue the detail for the particular customer on how much they owe us and how much they paid us. So that's why we then had to go into the specialized ledgers, like the accounts receivable ledger, and post those details there. But still, at the end of the month, it's less work than posting everything as we learned in Accounting 101. Believe it or not, this is a shortcut method. So let's start with Section 1, Cash Receipts. And our objective today is to record cash receipts in a cash receipts journal. Then we're going to account for cash short or over. And then we're going to post the cash receipts journal to the subsidiary and general ledgers. So first, we have a cash receipts journal in front of us. Note that it has the date. It has a description. What type of transaction is this? The posting reference that we've been very familiar with. And columns for, are we going to put a credit? Why are we receiving cash? We're going to, of course, debit cash over here, debit cash in our transaction, debit cash, and we're going to credit what? Typically, when a business receives cash, it's for a customer to pay off some of their accounts receivable. So usually it's a debit to cash and a credit to accounts receivable, and then you need to know the customer's name. You put that here. And then we have a situation where we have a credit to sales taxes payable and a credit to sales itself. And then we receive cash for any other reason. Then we put down the account name and the posting reference and the amount. And the description would be put over here. And we're going to go over some of this situations that goes into other. So here we show that it debits to cash. Oh, well, maybe not. Okay. So cash over short, or cash short over, occasionally errors occur when making change. So when errors happen, the cash in the cash register is either more or less than the cash listed on the audit tape. So when you, excuse me, so when you have the balance in a cash register, you know it from the cash audit tapes. What happens when the cash drawer, when you count it at the end of your shift, doesn't match the audit tape? So that's cash over short. So that either means, given that you are a good employee that's not stealing, that means that you either gave wrong change to your customers. Now, are you going to be in, well, you're going to be in trouble anyway, okay, because your cash drawer needs to be exactly what it should be. But which will get you in more trouble? Having more cash in your drawer than you should, or having less cash in your drawer than you should? Think about that for a second. If your cash drawer has less money in it than it should, or if your cash drawer has more money in it than it should. Well, would it surprise you that if you had more money in your cash drawer, then you could be fired, where you may not be fired if you had less money in your cash drawer? So why, if you had more money in your cash drawer than expected, why would that be a big problem for a business? Yes, you're right. It would be a big problem for the business because you gave out wrong change to your customer and you didn't give them enough change back. You cheated the customer. That's why you have more money in your cash drawer than you expected to. You kept more of your customers' money than you should have when making change. And customers are hard to get. Customers are easier to keep than they are to acquire. So when it's easy to keep them, one way of not to keep them is to cheat them in making change. And an unhappy customer will talk about that situation of being unhappy, and that bad word of mouth will travel faster than any good word of mouth can ever travel. So you will be costing your company customers by having a cash drawer that has too much money in it. So cash over could get you fired. So what's a promissory note? A promissory note is a promise. Okay, here we have July 31st, Max Out Sporting Goods accepted a 6-month promissory note from Stacy Fairley, who owed $800 on account. So this person, Stacy, couldn't pay their accounts payable. Their accounts payable, they couldn't. So your accounts receivable has been owed money by Stacy for a while now. So we decided to switch out the account receivable and make a note out of it. So this note, as you see, has a date, July 31st. It has a date. It has an amount, $800. So on July 31st, 6 months after date, July 31st, I promised to pay to the order of Max Out Sporting Goods $800, payable at First Texas Bank, value received with interest 9%. Number 30, this is note number 30, due January 31st, and then Stacy, the customer, the person who is signing the note that owes the money, signs it. So that's a note. You've signed probably car notes to purchase an automobile. Mortgages are an example of a note. So we have the amount owed of $800. The interest rate is 9% a year. So the rate for the 6-month period is 9% divided by 2. And that's 4.5%. So how do we calculate the interest at the end of this note? It's going to be $800 times 4.5%, which will be the amount of the interest, which is $36. So on the calculator, you only have to put in 800 times 0.09 divided by 2, and you will get $36. So the total amount owed at the end of the 6-month promissory note is $836. So here we have an example of a cash receipts journal that's filled out. We saw a blank one earlier in the first slide. So here we have Ann Ang, which we had last week, and she has accounts receivable of $702. This is cash receipts. So Ann on January 7th paid us $702. So we're going to debit cash and credit accounts receivable. Here we had a cash sale on the 8th. We're going to debit cash and credit sales and credit sales taxes payable. These are the same journal entries that we made in Accounting 101, but we didn't stop just at journalizing it in the journal entry format within the journal and then post it to the ledger. This is a summarizing way of saving work. So here, what happens with Vicki Bowman? Vicki paid us $270 for paying off some of her accounts receivable. Here we have on January 12th an investment. Again, this is cash receipts. So on cash receipts, this is the investment. Okay, so we got it from our owner, $15,000. So we got a debit to cash and a credit to M. Ferraro Capital. We put that account here because we don't have a column for the capital account. We don't have a column because these columns are established with the most often used accounts when we receive cash. Well, we receive cash most likely from our customers, and it's either going to be for cash sales or it's going to be for paying off accounts receivable. Those are the most likely debits to our cash account. Occasionally, we'll have an infusion of cash from our owners. So when those things happen, we then just go into, oh, I don't want to do that yet. We go into the other accounts. So we're going to debit cash $15,000 and we're going to credit $15,000 to the account in Ferraro Capital. So what happened with Barbara Coe? She paid us cash with accounts receivable. Here we have another cash sale. Alma paid us off our accounts receivable. Here's one cash refund. I guess we did a return of some sort or got a cash refund. So we're going to debit cash $75 and credit supplies account. Sometimes you buy office supplies and you get a refund or rebate. Then this is how we would do that. This would be a rebate. Fred Rue paid off his accounts receivable. We had cash sales, accounts receivable, cash sales, and note collection, Stacy Fairley. So we have Stacy paying us on January 31st. Remember that note was from June 30th? for 6-month note. I'm sorry, July 31st, 6-month note. And that's going to be, we're going to debit cash $836 and credit notes receivable and credit interest income by $836 respectively. Now we have the totals for each of these accounts. So we're going to have a journalizing entry to the general ledger of debit to cash $42,612, credit accounts receivable $2,403, credit sales taxes payable $1,800, credit to sales $22,500, and a credit to M. Ferraro Capital $15,000, a credit to cash over short $18, a credit to supplies $75, and a credit to cash over short of $16. So this is just a note that the notes and interest are recorded in the other accounts credit section. So now we have Chapter 9, Cash Receipts, Cash Payments, and Banking Procedures. So cash payments. Section Objectives is to record cash payments in a cash payments journal. Do you see a pattern here? So we just did a cash receipts journal. Now we're going to do a cash payments journal. So this would be on the credit side of our cash account. For the cash receipts journal was a debit to our cash account. Then we're going to post from the cash payments journal to the subsidiary and general ledgers. And we're going to demonstrate a knowledge of procedures for a petty cash fund. Then what about demonstrating knowledge of internal control and routines for cash? Because cash has no owner. A dollar bill on a table has no owner except to who actually possesses it. So here we have, okay, recording in a cash payments journal. We have, this is a cash payments journal. As you see on the very last column, it's a credit to cash. And the most likely times that we credit cash would be when we debit accounts payable or have a debit to other accounts. And then we also have purchases discounts. So here we're going to pay off our January rent. And it's going to be check number 111, January rent. The other account, since it's not accounts payable, and we don't have a column for rent expense, which we're not going to have a column for rent expense because it's only used once a month. That doesn't deserve a column on its own, so it's going to be in the other accounts section. So here we have account name, rent expense. The amount is $1,500, and you're going to credit cash $1,500. So now to post this to the journal, from the journal to the ledger, this is a cash payments journal that we just saw. And we're going to go to rent expense, the actual account in the general ledger. These are our T accounts in the general ledger. And we're going to do a cash payments, CP cash payments, CP cash payments, page 1, that's the posting reference. Debit, other accounts are being debited that are under here. So we're going to debit rent expense, debit 1,500. The balance, since there was no beginning balance, the balance is now 1,500. And do you see where the 634, the account number itself for rent expense, then gets put up into the cash payments journal to complete the circle? So to demonstrate a knowledge now of the procedures of a petty cash fund, first let's talk about what is petty cash and what does a petty cashier do. You have one in most every business because it's the cash kitty, let's say, that a business has, and it's usually in someone's desk drawer locked up or in the owner's office, and it has a prescribed amount of cash in it, and as opportunities come up that need cash now, then someone goes to the petty cash and takes out the cash, spends that money at that moment, and then puts in a receipt into the petty cash box. So money is in the petty cash, ready to be spent, and as it's spent down, then a receipt replaces the cash that gets spent. So what would be some reasons for what would you use petty cash for? Have you ever been in a business where the mailman comes in with your mail for the day, but then there's a postage due on that envelope? Is that mailman going to wait around for you to write a check, to get it approved, then to write a check, and then to get the check signer to sign it? That mailman isn't going to stay there that long because he doesn't have time on his route or her route to stay there to wait for your business processes to occur. So if there's $1.28 that's due for postage for him to deliver this package, then someone's going to go to the petty cash box and say, take out $1.28, give it to the postman, you get a receipt, and you put that receipt into the petty cash box. Do you ever have pizza parties at work? Well, that probably usually comes out of petty cash. What about someone needs to go, you need some stamps. You need to go out, someone needs to go out and buy some stamps from the post office. Well, are they going to want to use their own money as an employee and then wait for the company possibly a month later to reimburse them for using their money for business purposes? No. They're going to get money out, they're going to be given money out of the petty cash box, take that money personally to the post office, buy the stamps, get a receipt, bring that receipt back, and it goes to the petty cashier, and the petty cashier puts it back in the box. And then at the end, we make a journal entry when we actually replenish the cash. So here, demonstrated knowledge of the procedures for a petty cash fund. We have a petty cash voucher. It shows that we spent we paid amount for office supplies. The account to be charged is account number 129, and it's for $16.25. This form must be computer processed or filled out in black ink. So this is now taken to the petty cashier. So use the petty cash fund only for small payments that cannot conveniently be made by check. This is like the postman dancing at your front door going, I need to get going, but I need my postage due. You're going to limit the amount set aside for petty cash to approximate the amount needed to cover 1 month of payments from the fund. Typically, petty cash is $100, maybe $200. You write a petty cash fund check to the person in charge of the fund, not to the order of cash. Well, I've seen it happen before and I've done it. I've written a check to petty cash. And then that check I take to the bank, and I take the cash that the bank gives me, and that goes into my petty cash box. Here it's saying that I shouldn't write to cash, but I should have written a check made payable to me. It's either to me or to the petty cash itself. And then that establishes the amount in the petty cash box. And assign one person to control the petty cash fund because, again, cash has no owner, and you have to have one person responsible. And this person has sole control over the money and is the only one authorized to make payments from the fund. And the petty cashier should keep the petty cash in a safe, a locked cash box, or a locked drawer. And to prepare a petty cash voucher for each payment. The voucher should be signed by the person who receives the money and should show the payment details. This provides an audit trail for the fund. So now we're going to demonstrate knowledge of internal routines for cash. Have only one designated employee receive and handle cash in the business. In some businesses, employees handling cash are bonded. That's an insurance put out on that person, and it's a bond. And that bond basically is a bond that person is trustworthy. Keep cash receipts in a cash register, a locked drawer, or a safe where they are on the premises. You make a record of all cash receipts as the funds come into the business. Is this the cash journal, the cash receipts journal? Yes. Check the funds to be deposited against the record made when the cash was received. The employee who checks the deposit is someone other than the one who receives or records the cash. So we have someone recording the cash in the ledger, someone else who receives the money, and someone who checks the deposit. It can't be the same person. Cash and deposit cash receipts in the bank promptly. Deposit the funds intact. The person who makes the bank deposit is someone other than the one who receives and records. And number 6, either enter the cash receipt transactions in the accounting records promptly. The person who records cash receipts is not the one who receives or deposits the fund. And have the monthly bank statement sent to and reconciled by someone other than the employees who handle, record, and deposit the funds. So that's cash receipts. Now what about cash payments? So you're going to make all payments by check except for payments from special purpose cash funds such as petty cash. So everything in a business should be written as a check. Issue checks only with an approved bill, invoice, or other documentation that describes the reason for the payment. And have only the designated personnel approve bills and invoices. Have checks prepared and recorded in the checkbook or check register by someone other than the person who approves. So you're not going to have someone writing checks, approves them, and signs the checks. That cannot be the same person for either one of those combinations of three functions: writing, approving, or signing the check. Have still another person sign and mail the checks to the creditors. Consider requiring that two people sign all checks greater than a pre-designated amount. Use pre-numbered check forms. During the bank reconciliation process, compare the canceled checks to the checkbook or check register. The person responsible for this should be someone other than the person who prepares or records the checks. Enter promptly in the accounting records all cash payment transactions. The person who records cash payments should not be the one who approves payments or the one who writes the checks. Excuse me. So now, banking procedures. Objective number 8, write a check, endorse checks, prepare a bank deposit slip, and maintain a checkbook balance. Reconcile the monthly bank statement and record any adjusting entries required from the bank reconciliation. Understand how businesses use online banking to manage cash activities. So sometimes there's a difference between the bank balance and the book balance, and sometimes that difference is due to errors. So errors made by the banks. Well, they can be math errors. They can give credit to the wrong depositor. And they can charge a check against the wrong account. And errors made by businesses. Well, let's go back. These three, especially giving credit to the wrong depositor and charging a check against your account, and it's not the check that you wrote, it's someone else's check for their account. This is why you want to reconcile the bank statements to your cash account. And you need to do this personally too. Because sometimes things happen to your checking account that you did not approve or authorize. And sometimes they're just made by errors. So what about businesses or you personally for your own checking account? You can make math errors. You can not record a check or a deposit, and recording a check or deposit for the wrong amount. And many banks require that errors in the bank statement be reported within a very short period of time, usually 10 days. So the format of a bank reconciliation statement. So you have two sections, the first section and the second section. And here, let me just talk about this. The first statement takes the bank statement itself, that balance, and you come down to the adjusted bank balance. So what happens here, you have an amount on the bank statement as the checking account balance. This is a statement that comes from the bank. Now you have to add to that or subtract from that transactions that the bank does not yet know about as of the date of that bank statement. So if the bank statement was printed and created on the 30th of the month, and then on the 30th, the afternoon of the 30th, you go to the bank and make a deposit, it's not going to be, it probably won't be on the bank statement that they sent out to you that was dated that was dated on the 30th. So that would be information that the bank did not know about at the time it produced the statements. What about checks that are still haven't been cashed by the people that you wrote them to? So those are outstanding checks. You know that you wrote them, but the bank doesn't know that they exist yet because it hasn't gone through the banking system because the person hasn't cashed a check. And then plus or minus banking errors. Now the second section will take the book balance to the adjusted book balance. The bank statement probably will not equal the book balance before you reconcile. So what items would we use to reconcile the book balance? That would be stuff that the bank knows about that the company doesn't know about yet. And you find out from the bank, from the mail, or from items on the bank statement. So the bank could have a deposit made that you didn't know about or you didn't record. And that wouldn't be in your general ledger. A deposit not recorded that you wouldn't know about. What about interest that the checking account earned? $2.58 interest. So that would be a deposit to your account that you did not know about until you get the bank statement. So that would be something that you would have to add. Deductions. Deductions for banks would be service charges, NSF fees, non-sufficient funds fees, and you may have some interest expense that they take from you, or some other bank service fees that they take. So those are all, so the deductions usually are bank fees, and you will find those on the bank statement. So plus or minus errors in the books. So you go from the bank, from your bank balance, from your book balance, plus or minus the stuff that the company didn't know but the bank knew, to get your adjusted book balance. You take the bank statement and add, subtract things that the bank doesn't know about that you know about to get the adjusted bank balance. And at the beginning, these are not equal, but at the end, the adjusted bank balance should equal the adjusted book balance. So that ends the presentation on the actual chapter itself. So let's go to the homework that's due for week 3. Let me sign in. I had it up beforehand, but I lost it. Okay. Module week 3. Week 3 assignment. Okay, so week 3 we have discussion, which is going currently. You have the assignment due Saturday, the assessment due Saturday, and you can practice on your practice quizzes, and that hopefully that helps your assessment. So week 3 assignment. you are a new computer sales promotion, and you're trying to encourage new sales. So you have a promotion, and you hope that gets you more customers for your store for February. And we have the template, but we're going to go over that in a minute. And you have the following transactions. You receive a check from Pinpoint Marketing to pay their balance due. Where would you put that? From this lecture, you would put that in the cash receipts journal. You issued a check to Elite Computers for $5,500. That would be a cash payments journal. Receive a check, cash receipts. Several cash sales customers purchase new computers. Cash receipts, because they're cash sales. Receive a check from Able Landscaping paying their balance due. What do you think? Receive a check, cash receipts. How about cash sales for the day are $4,500 plus sales tax? At the end of the day, the cash register was short. So you had cash sales for the day, cash receipts. Cash register is short. That's going to be a debit or a credit to cash. Your cash is short. That would be a credit to cash to reduce the cash balance. So that would be in the other section of the cash disbursements journal. Issue check, cash disbursement. Smith and Jones Builders calls to discuss their past due invoice. They request 6 months. You convert their accounts receivable to a note receivable due in 6 months. And you have inventory on small computer accessories running low. You purchase miscellaneous computer accessories and you write a check, number 1013, so that would be a cash payment. So the requirement is to make sure that each transaction, that you record each transaction in the appropriate journal, sales journal, purchases journal, or general journal, and make the necessary posts to the subsidiary ledger, accounts receivable or accounts payable, and do that daily. Then at the end of the month, properly total the cash receipts and cash payments journal columns and post to the general ledger. Any entries to the general journal are to post immediately. And then that's due by Saturday evening at midnight Mountain Time. So let's take a look at week 3 assignment. Okay, we have at the bottom here journals, a tab for general ledger, and a tab for subsidiary ledgers. So we have under journals, we have cash receipts journal, your cash payments journal, and your general journal. So cash receipts journal, that's again everything that is yellow, I expect something in there. There's yellow and yellow. There's a lot of yellow on this sheet. So I expect something in each one of these yellow spaces in order for it to be correct. So cash receipts journal, this is where you debit cash, you credit either accounts receivable or you credit accounts sales with a sales tax payable credit, or you credit some other account that aren't receivables or sales tax related. Under the cash payments journal, this is entries that you make that credits cash, which reduces cash, and you have to reduce cash, you're either going to be paying off your accounts payable or you're going to be writing a check for something else that didn't go through the accounts payable. And then the general ledger, the general journal is probably where you're going to reclass the accounts receivable to the notes receivable in this problem. So let's look at the general ledger. The general ledger has cash, accounts receivable, notes receivable, has accounts payable, sales taxes payable, and sales, has purchases, has freight in, has utilities expense, and has cash short over. These would be the receivers of the last line here of your journals, your cash payments journal and your cash receipts journal. In fact, the journal entry that you would be posting to the ledger will be debit to cash for this amount. Then you're going to credit accounts receivable for this amount, credit sales taxable for this amount, and credit sales for this amount. And if you have any things here in the other accounts area, then that's where you're going to actually, and you do have one here, actually that would be a journal entry that you post to the ledger also based on this particular account. So go back to the ledger. No, next is the subsidiary ledger. Excuse me. So the subsidiary ledger, here's the accounts receivable ledger for Speedy Freight, for Pinpoint Marketing, and for Able Landscape and Smith & Jones Builders. Those are your customers. And here is your accounts payable ledger, and you have one vendor that has issued you credit, and that's Elite Computing. And looks like the transactions from previous months are in here, and you have the current transaction that you had to place, because there was a purchase that I remember reading to you. Then Smith & Jones Builders basically is now having a note receivable instead of an account receivable. And Able Landscape probably had a payment, Pinpoint Marketing, as well as Speedy Freight. So basically, you start with the journal. You put those transactions in summary form into the general ledger, and then for those accounts receivable and payable accounts, you need to put those into the exact customer accounts or vendor accounts so you can maintain and know how much your customer owes you by customer and how much you owe the vendor. So hopefully this has helped. Next week, I will do a quick review over these 3 chapters, and then I will show you what QuickBooks looks like to let you know that what you're learning here is actually what happens in industry. So I'll give you a quick tour through a QuickBooks file, and do me a favor and give me a message that tells me that you heard about the QuickBooks offer. Okay? Take care. I'll see you next week.